Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's mission, we are continuing our options series and are zooming the call option. The objective is simple: understand what it really means to buy a call, what it means to sell a call, and how the basic profit and loss works so you do not blow a hole in your account. So, gear up and let's go to work. Quick recap from previous episode. A call option is a contract that gives the buyer the right, but not the obligation, to buy an underlying asset at a fixed price, the strike, on or before a specific date. The underlying can be a stock, an ETF, or an index. The buyer of the call gets a right, the seller takes on an obligation. If you remember nothing else about calls, remember this: call buyer, right to buy at the strike; call seller, obligation to sell at the strike if assigned. Everything else, profit, loss, risk, flows from that simple contract. First, imagine you are the buyer. This is called a long call. As the buyer of a call, you pay a premium up front. That is your debit. In return, you get the right to buy the underlying at the strike before expiration. You want the price of the underlying to go up, ideally well above your strike plus the premium you paid. At this point, it will be good to make a short side brief on the call price. As a general rule, the call option will be worth the minimum the difference between the strike price and the current price. For example, if the strike price is 50 and the current price is 55, the option is worth at least $5. Multiplied by 100, that is $500. That is called the intrinsic value. To simplify, whatever is above that number is the time premium. So, if the strike price is at 50, the current price is at 55, and you see your call is worth 6.5, that means $5 is intrinsic value and $1.5 is time premium. Remember one of the key points from Options 101. When buying a call, time is your enemy. The time premium will decays, as the option approaches expiration. Why? Simply said, because the less time is available, smaller the chance the stock will make any big moves in either direction. If the situation would be reversed, for example, strike price is at 55 and the current price is at 50, your option has zero intrinsic value. If it has value, it is only the time premium. So remember, only in-the-money calls have intrinsic value. Let's walk through a couple of examples and then do one real case scenario. First, you are the buyer of a call. The assumptions are: the stock is trading at 50 and you buy 50 strike call for a premium of 2. As one contract controls 100 shares, you pay $200 in total. Let's now assume 3 basic scenarios at expiration. Number 1. The stock is at 45. We can immediately see that your right to buy at 50 is useless, as you could buy the shares cheaper at 45 in the market. Hence, it makes no sense to use your right, that is your call, and the call will expire worthless. Your end result is you lost the entire 200 premium, and that is your maximum loss. Number 2. The stock is at 52. Your right to buy at 50 is worth about 2 per share. If we multiply that with 100, we end up at 200, which roughly matches what you paid for the call. In this scenario, you are in break-even territory, ignoring fees. To calculate the break-even price, use your strike price and add the premium you paid. Number 3. The stock is at 60. Your right to buy at 50 is now worth about $10 per share. Your call option has around $1,000 of intrinsic value. Since you paid $200 for the contract, you end up with about $800 of profit. A large percentage return compared with buying the stock outright. If you are unsure what that means, just look at the simple math. You risked $200, the premium paid, to gain $800 of profit, which is 400% gain. If you would instead go the stock buying route, you would risk $5,000 to gain $1,000, which equals 20% gain. The difference is obvious. Let's go back to our example. You can see the basic shape of a long call. Maximum loss is the premium you paid, $200 in this example. Upside can be large if the stock moves strongly in your favor, but there is no guarantee it will. Remember one more factor that wasn't included here but you cannot ignore: time decay. Every day that passes without the stock moving your way chips away at value. As a call buyer, you are fighting both price and the clock. Now flip the perspective. Imagine you are the seller. This is a short call. As the seller of a call, you receive a premium up front, that is your credit. In return, you take on the obligation to sell the underlying at the strike if the buyer exercises or you are assigned. You want the price of the underlying to stay at or below your strike, or at least not run far above it. Let's use the same assumptions. Stock is trading at 50, you sell the 50 strike call for 2. You receive $200 in premium. There are two very different worlds here: covered and naked calls. In a covered call, you already own 100 shares of the stock. If the stock stays at or below 50 until expiration, the call expires worthless. You keep your shares and you keep the 200 premium as profit. If the stock finishes above 50 and the call is exercised, you must sell your 100 shares at 50 no matter how high it went. You still keep the 200 premium, but your profit on the stock is kept at the strike. Covered calls are usually neutral to mildly bullish strategies. You are okay selling your shares at the strike and earning some income while you wait. In a naked short call, you do not own the shares. If the stock stays below 50, same story. The call expires worthless, you keep the 200 premium. But if the stock runs to 60, 80 or higher, you might have to sell at 50 while buying at the much higher market price. That means your maximum profit is still just the 200 premium, but your potential loss can be very large, in theory unlimited, because there is no cap on how high a stock can go. As a short call seller, time is on your side, but the tail risk, that big move higher, is what can blow up an account if you're not covered or sized correctly. As selling covered calls is one of the highly used strategies, we will fully cover it in one of the future episodes of the options series. Based on what you have learned today, here is a study example for you to solve. Graph next to the option chain is to help you better understand the dynamics of call buying. Assumptions are: you are a call buyer of Chevron January 16 call option, strike is at 150 and the ask is $4.6. Calculate cost per contract and max loss. Hint, the number is the same. What is your break-even price? And what is your maximum potential profit? Now pause the screen and try to calculate or read the results from the graph. I assume this wasn't too difficult. If this is the first time you see an option graph, let me walk you through it. At the bottom edge, x-axis, you have the stock price. On the left edge, y-axis, you have the dollar amounts. Positive numbers mark profit, negative numbers mark the loss. The line shows you your loss territory, your break-even, and your potential profit. This can be relatively accurately plotted with just 3 data points: your maximum loss, strike price, and break-even price, all of which you know how to calculate. As your loss is limited to the premium paid, the maximum loss is fixed and it goes in a straight line. Next, we know that as soon as the stock price goes above the strike price, it starts gaining intrinsic value, which means the line will turn upwards. Once the intrinsic value reaches the amount we paid for the premium, we are in break-even territory and everything above is profit. This wraps our study case, and now let's quickly go through some traps that ambush many retail traders. Number 1, buying cheap, far out of the money calls just because they're only a few bucks, without realizing the low probability of finishing in the money. Those are lottery tickets with very tiny odds of success. Number 2, oversizing call positions because the most I can lose is the premium mindset, then repeating that premium loss over and over until the account bleeds out. Number 3, selling naked calls for easy income without understanding assignment risk, margin calls, or how bad it gets if the stock gaps higher. And number 4, using calls without any position sizing protocol or exit plan, ignoring the risk limit set in your own rules of engagement. Calls are powerful tools, but if you treat them like lottery tickets or free income, the market will eventually collect. Options are tools to shape risk, not shortcuts to quick riches. A call option lets you attack with limited downside as a buyer or earn income with defined upside and potentially larger risk as a seller. Used with discipline and proper sizing, calls can be a precise weapon. Used blindly, they will blow up a hole in your own account. You now have a clear picture of call options. Long calls versus short calls, where the profit and loss come from, and where the big risks hide. In the next mission, we will move to put options and what obligations you carry when you sell protection. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on time.